Welcome back to another episode of Multifamily AP360. And today's our guests are Tyler Lekas and Jason Postill from MHCI Group. Welcome, Tyler and Jason.
Hey, Rama. Thanks for having us.
Sure. Thank you very much. Let's start with Tyler. Tyler, go ahead and share me your background.
Yeah, so I started off on Wall Street. I was trading fixed income for a firm there, and worked there for about 5 years, working like 120 hours a week. So I figured there had to be like kind of a better work-life balance. Even like 80 hours I've been good with, So, anyways, I didn't really like my job, but I didn't really know what else to do. And my dad ended up sending me an article about mobile home parks. And he basically, kind of tongue in cheek said, these real estate guys aren't very smart. They can't run numbers like you can. So you should start looking into the asset class because I think you could do pretty well with this. So I started looking into the asset class, and it's got some pretty intriguing, metrics. It's the only asset class in commercial real estate that I know of that has a declining supply. So they actually tear down more mobile home parks each year than they build, and it had some interesting demographics as far as how many families need affordable housing, owning just the lot versus owning the actual structure. So I started looking into all those. Seemed like a pretty intriguing asset class. So I quit my job shortly after, bought my first park in 2018, and met Jason in end of 2018, beginning of 2019. And it's actually a pretty funny story. We'll tell it maybe later in the podcast how we met. And then me and Jason acquired our first two assets together in Arkansas. I moved there, and then the rest is history. We bought basically 16 assets, a little less than 700 units, in last almost 48 months.
Awesome. Thank you. So Jason, share me from your side, your story.
Sure. Yeah, I'm Jason Postill. Out of college, I played professional baseball for about 5 years and knew that was going to come to an end at some point, right? And I heard a big leaguer at one of my last pro camps. He was saying he didn't make his millions playing professional baseball. He made it owning thousands of apartment units in South Detroit. And so I was kind of like, oh, okay, that I always gravitated to real estate, but didn't really have friends or family in the business to really see what niche I really wanted to get into. So got in just general real estate brokerage, narrowed that down into apartments because that was always in the back of my mind. Ever since that day, I've drive by apartments, see, wow, they're paying $2,000 each unit. Whoever owns that, I mean, it's like, who owns that? And then you start asking those questions, read, do some self-educating, and start selling apartment buildings. And then around 2017, I went independent because finding all these deals for everybody else. I said, I want to start. I didn't have a 401k, didn't have really an investment, saving up. So I just thought, hey, I got to get into buying these and owning these and building my passive income. So yeah, like Tyler said, when 2018 we met, and it was through cold call. It was funny because it was still on the brokerage side, and he hung up on me, on my face, and called him back and meeting, and we were really aligned in what we were both trying to do. And then, like you said, once we got our first deal done in 2020, it caught fire, and here we are. So
awesome. Thank you for sharing your background, how you started the mobile home park space. Thank you. We'll start with how exactly you joined. When you selecting partners, what do you see? We'll start with Tyler, then we'll come back to Jason.
When we're selecting a partnership, I never really had a partnership for Jason. So, I mean, as we've kind of gone through this, we've kind of, figured it out. But I mean, like, if you had to tell me what I was looking at or what I should have looked for back then, is your goals have to be aligned. So whatever business whatever entrepreneurship, venture you're going down. We're in mobile home parks. And so, as a, kind of a top down kind of macro view, right? You have to be aligned on either, are you a buy and hold, or are you a quick flipper? Are you looking for the big IRRs? Or are you looking to buy and hold for 20 years and keep, pass these to your kids? Jason and I are both aligned as we're buy and hold guys. And so that really has allowed us to kind of build something, because we have a vision for the future where we want to buy 10,000 of these 10,000 lots in the next 5 to 6 years. And so, but if he was a quick flipper, or I was a quick flipper, and he wanted to hold long term, I mean, there's no way we would just diverge almost immediately. Obviously, morals and ethics is super important. And I think having different strengths is also really important. Jason can actually operate a computer. I usually don't touch those things. Technology is usually not my friend, but I'm pretty good up front. I'm pretty good with dealing with problems and kind of our difficult tenant base on the ground here. And again, there's a ton of overlap between Jason and my responsibilities, but we're kind of a good yin and yang, So Jason, what'd I miss?
Yeah, no, it's, when you get into partnerships, especially if you haven't been in any, right? I mean, out of college playing baseball, I was just with playing sports, didn't have a business even mindset. So you really don't even, it's not like it comes with this manual, like set duties here, set duties there, and some detailed process, which, yeah, going back now, it's like, hey, we're still building processes out in our management company, and having known that, like, oh yeah, that would have been great to have all laid out before we got to almost 1,000 of these, but you're just kind of figuring out along the way. But yeah, and then you don't even know what there is, what kind of holes are there to fill. So yeah, having that alignment, you don't really meet a whole lot of people that say, hey, I want to get to 10,000. Oh, I do too. Like those are goals that not everybody has. And then when you come across people that are aligned, it obviously makes the partnership a lot smoother. So it's more like everything Tyler really said, and also just even doing work before there's any gratification, right? For almost 2 years, we were under due diligence, just getting our tail kicked for, I say 2 years, maybe it was a year and a half, but not getting a deal done. Tyler had already owned an asset. I hadn't owned anything but a home, at that point. So it's getting through that first deal. Oh, it could break a lot of people because you're like, God, spending money on due diligence, nothing's coming. Then and so seeing that work ethic on just, hey, this guy's hanging in here. He's not giving up, and that's where it then kind of led. But yeah, there definitely wasn't a checklist or any manual on partner picking. It was kind of like, hey, this guy works his tail off, and it's aligned. So
Awesome. Thank you both for sharing that. So from acquisition side, what is the reason behind targeting only Arkansas market? And what's your, deal criteria?
We chose the Arkansas market actually because of, I wish I could take more credit for this, but I talked to a gentleman named Frank Rolfe. And Frank Rolfe, he owns well over 20,000 lots in the mobile home park space. And I don't know how that guy's always on answering people's calls, but it's again, he's a workaholic. But I ended up talking to him one night at like 9:30, 10 o'clock at night, and we were trying to find a direction to go. And he basically said, he was like, look, I hate the whole Southeast, but if I was going to start buying anywhere, because I would really look at the Little Rock market. So we started looking around there for a little bit. And one of my buddies that just started working at Marcus and Millichap, he called through, he found these two deals for us. We ended up buying those two deals and then kind of scaling out there. But the other thing we found about the Arkansas market is that there's a pretty large arbitrage between where rental rates are at and then where land values are at, right? And what I mean by that is, if you go buy a house in Malibu, right, or a cash flowing asset in Malibu, you're gonna be paying for the dirt. That's why the cap rates are so low, right? Because the dirt is valuable in Malibu, right? In Arkansas, the dirt's not that valuable. So you get real cap rates going in, right? You get really good yields going into these assets. Because the dirt's not worth that much. So you're not paying for that underlying value. So we found that there's a big spread between where rental rates are and where you can buy kind of an acre of land. So we think that those yields continue to kind of propel these assets forward for us. So that's basically why we chose Arkansas. Why we chose the market. Jason, you want to take buying criteria and add anything to that?
Arkansas, there wasn't a lot of competition there. Being here in just Florida, just these sellers are getting 100 calls a day from brokers, other buyers, and so having a less competitive market. I mean, now we're starting to see an influx of investors coming in. Fayetteville is a pretty hyper competitive market, but yeah, the competition, it wasn't, we weren't competing against these institutions, just paying cash, quick close, 4.5, 5 cap, but yeah, our buying criteria too, we've really capitalized on those small to mid-size opportunities, because what we found was, the private, I call them the weekend warrior, nothing's against them, right? Those guys are doing it, they're working full-time jobs and making it happen on nights and weekends, but it is tough for a private guy to maybe take down a 33 site park, by himself, solo. And the institutions aren't even looking at it, right? Arguably under 500 units, 100, 200, 500. So we found that taking down an 18, a 33 site, a 43, we were able to just take down, and well, I think in that 24-month period, we had, I don't know, 6 or 7 deals we purchased, and nobody was calling in on those. So those are tough if you're just in a random market and have an 18 spacer, you can't support management, right? But what we were doing is stringing together the 18, the 22 in about a 3 to 5 mile radius. So then that helped the management. Well, now at this point to have a quality district manager at a nice salary. So yeah, our buying criteria, I mean, we love the larger assets now, obviously, seeing it's easier to manage being on one parcel, 100 plus units, direct bill to city, all the tenants on their own, perfect deal, right? We get us that. But yeah, we're still after those small to mid size, but we are able now to take down a little bit larger assets. But our largest at this point is 122, and then we've had majority, when you do the math, it's 100 or 700 across 16 communities, about 40 sites. So those have been the opportunities we target, and we've done well with those, and we're going to continue to do that and mix in, of course, the larger deals. But we'll spread throughout the Southeast as well. I mean, we've still got quite a few we're looking at in Arkansas where we're at, but we're going to be growing Southeast for sure.
So thank you. From location wise, demographics wise, or any other specific parameters you guys will look?
Yeah, we like metros over 50,000. And, I say that, and then I'm going to talk out the other side of my mouth. I don't mean to sound like a politician here, but, like our largest asset, it's in a town of 5,000 and the metro is about 33,000, right? So there is one-off assets like that we buy, but we're opportunistic, right? And we know Arkansas really well. And so that town of 5,000 that we bought our largest asset in, it's 122 spaces. We did that because we know Arkansas so well. So that, the devil's always in the details. But as far as demographics go, again, it's, 50,000 plus metro. We want to see 100,000 median home prices. We'd like to see at least 40,000, for the median household income. And we like to see, the vacancy rates at, 5% or less. So that's kind of the ball, it's not black and white, but that's kind of the metrics we try and stay in. Jason, did I miss anything there?
No, that nailed it. We've done really well in markets. Yeah, we have our go-to, but we'll also take like that 122. Yeah, that was a very, very small town, but we saw some good economic drivers, some larger employers that our tenant base was relying on, right? So that's a little scary in itself, but done well pivoting a little bit. But yeah, that nailed it.
Awesome. Thank you very much. So let's move towards capital side. So what kind of loans from debt side you guys will getting, and from equity side, are you putting your own money or you're raising capital from investors?
Basically, most of our deals have been with local and regional banks, really local banks. And thank God for local banks, because nobody else would have given us a shot when we were first starting out here. Because, people just don't like mobile home parks. And if you can sell, a local bank a story and kind of sell them yourself, hey, look, we're here, boots on the ground. Not only that, but we've got systems in place. You show them a good package. It's not, JP Morgan Chase, where they've got 9,000, miles of red tape they've got to go through to get from basically the loan officer to the loan committee. They can, you talk to one guy at one bank and he'll give you a loan. So, thank God for those guys. And our first 7 deals, we basically put capital in, Jason and Mai's capital in, ourselves, and raised a little bit of money for those deals. But we basically, we funded those deals ourselves and really kind of perfected the model. And, thank God we did, because we've had some stumbling blocks. I'm sure just like you, Rama, it's you buy your first deal and you don't know what you don't know. You can read every book on the planet and you're going to get blindsided, by something. And there's stuff out there that, if you didn't read a book, you'd maybe go under, but the books help you kind of get the framework, and then the details are in when you actually make your first acquisition or your first couple acquisitions. So now the equity side, we're out raising capital. So we're doing syndications, 70-30 split, 10 pref. We're actually raising capital for 2 deals right now, 281 units, city utilities, paying out basically a 1.7 equity multiple. So we think these deals are, incredible, and raising capital for that right now. But yeah, that's how we're kind of doing it these days. But we kind of started with our own money, then kind of did some co-GP, and now we're kind of moving to the syndication side of things. Jason, what did I miss?
Yeah, that's been exactly it. And the local banks, that's really where we've gotten these, especially smaller deals done. They're tough. A lot of lenders we heard, oh, nothing under 2 million or under $1 million they don't touch, or tenant-owned homes versus park-owned homes. They are challenging to get, even though in our opinion they're the safest asset class there is, right? Affordable housing, that's the demand across the board. So finding those relationships locally with small local banks, they want the deposits, right? And they see the rental and the demand, and like Tyler said, the business plan was huge, and being local and having that relationship really helped. So we've done well there, and now we're getting larger deals that will have agency and some other contexts now that we have with the track record will help. But yeah, the syndication model, that's really now at this point where, tapping out on the smaller deals and even the larger deals with our own personal cash, we see this as a way to scale. So we're going the syndication route, and we have 2 offerings so far, 506B offerings in a syndication format, but now we are getting a little louder about it and putting them out there. So that's, yeah, exactly where we're at.
Awesome. So did you guys see any challenges on debt side or equity side in last 2 years?
I mean, we paid some aggressive. I mean, last year we paid a 9.25. I mean, that's a big number for debt. That'll have a lot of people sitting on the sidelines. Was also where we still found some opportunity. I mean, 3 years we've just been hammering into this market where now we're getting inbound calls from these sellers. We've been cold calling them and on them, but the debt has been challenging because to make pencils work, we're still in that time where sellers 2020 pricing, they're having a hard time letting go of that. And we're still seeing that. And it's almost like, oh, well, we're blind at the interest rates. But now that they're hearing that over and over, the debt service can't be paid. We are seeing some discounts now. And then there's also people more so in apartments right now. It hasn't been so much in mobile home parks where people are needing to reset that debt, right? They're coming due. They're looking at a technical default because they bought a 4 cap 5 years ago, and that debt's coming due now at a 6, 7, 8. So there are a lot of opportunities, and I know that's bringing on some challenges. But yeah, for us, it's really just making sure we're getting, if we're paying that high price, we're finding now that owners are willing to finance at those 2020 interest rates, right? If they want that price that high, well, it's got to align with the debt. And so we've definitely had challenges with that. And last year we get a deal done. It's going to be a really good project. And we paid, 9.25, and we're still getting some aggressive pricing, but we're making the deals work. So Tyler, what were your thoughts on the?
Tyler, you want to add anything on top of that?
Yeah, I mean, Jason, you nailed it. I mean, basically, if you pay really high interest rates for your first lien debt, you better have a good DSCR up front because, that DSCR is not only for the bank, but it's also for, gauging the actual metrics behind it. The interesting thing too about, debt pricing in these days, and I think it's been a good opportunity for Jason and myself, is we're still out there aggressively pounding on doors. And I think that in the mobile home park space, there's enough runway in the rents. And we have enough scale in Little Rock now to where if maybe a smaller operator came in, they wouldn't feel as comfortable maybe pushing rents from 350 to 400, but we own the entire city of Little Rock, basically. We own about 400 units here. And so we got this economies of scale now to where maybe the debt pricing would push out a smaller operator, but we can go out and push rents a little bit harder and a little bit faster, as well as we've got economies of scale on our management side, so our fixed kind of costs. And so we can actually go out there and operate more efficiently than somebody else that's just coming into the market. So anyways, I think those 2 things are helping us mitigate that debt risk that a lot of other operators are seeing right now. So.
Yeah, got it. Thank you very much, both. So moving towards operation side, so far you guys like 16 deals, like close to 700 units in one state, right? So what kind of systems and processes you are implementing to increase like income and reduce expenses, or controlling expenses and increasing overall net operating income?
Yeah, so our policies and procedures, our SOPs, they're light years away from being done. And hey, our investors out there got most of our stuff dialed in. So if somebody's listening out there and they want to invest with us, we got a stable management company and all that, but we really got to dial in all the details because your employees really are what's going to drive the efficiencies throughout a portfolio, right? You get to 1,000, 2,000, 3,000 units. Right, you're not going to be able to do everything yourself. So you have to have those SOPs in place so that your employees are basically, they know exactly where they need to be, what time, how they're going to show homes, how they're going to collect rent, everything from nuts to bolts. So, basically how we're doing that, you asked what type of systems we're implementing right now to make sure that we can, drive our bottom line income, our net operating income. We're putting in, policies and procedures and have put in policies and procedures on, how to show vacant homes. So just to give you an example and kind of dive deep just on vacant homes, right? So home becomes vacant, manager walks through and has a checklist of everything that needs to be done. They upload that into our CRM. We take a look at it, right? And we've got kind of a construction crew that goes through and rehabs all this stuff. So then they'll take a look at the checklist, they'll go back through, they'll rehab it. The manager will go back through and make sure it gets done. Then, we've also got for vacant units, what you do in the summer versus what you do in the winter. Hey, when it's in the summer and you're not showing the home, turn up the AC to 80 degrees. If it's in the winter, turn up the heat or turn down the heat to 50 degrees, right? You don't need to waste a bunch of electricity on those homes. Plug in your Glade air fresheners. Make sure it's swept in there. There's no cobwebs in the corner. I mean, again, all this stuff that I feel like is common sense, but a lot of people, are either lazy or they don't care or a combination of the both. So you got to write them down so that there's a playbook for them to go through. So, again, we're doing that for everything in the portfolio to make sure that things are dialed in, because that's where you're going to drive all those efficiencies, where you don't have to take up your time and you can continue to grow the business versus be in the business dealing with a vacant home or dealing with water leak or dealing with whatever. So Jason, what I miss?
Yeah, we talk about it quite a bit, right? Like working on the business instead of in it all day, right? And it's tough, and essentially, I mean, we're a startup essentially, right? 4 years into this, we're growing quickly, but getting all those pieces together, that it has been challenging, because nobody's going to care like the ownership group, right? So when you're hiring out these other managers, but the cash generating items are filling those vacant homes. Well, what's the process to get those filled? When you're having some managers that you might be able to give them free lot rent, or, just now, like I was saying, we're getting to the district manager role, so it supports a nice salary. We didn't always have that, right? So having those home showings when that manager has to work maybe another job, that's been a hole, right? It's like, well, we got a line out the door of these prospects to get in. So now we're looking at, it goes back to the system. So okay, we have a process, full-time leasing agent to hook the showing for the manager, but if the manager isn't there or can't be there, well, we're missing income. So now we're looking at, there's electric lock boxes we have with we use a system called ShowMojo, which gives us a lot of leads, and then just perfecting that process. Because again, we're building it. We're not leaning on a third party. I'm not saying apartments are easy by any means, right? It's not, but there's a lot more third-party management and leasing teams that you can rely on. And so building that has been a challenge, because we love the deals, and that's another cash generating item. But if we don't have the systems dialed in on what we got, then we're not going to scale too far forward. So yeah, it's come back to those P's, building those out, and just having a detailed process to fill those homes.
Awesome job. Thank you for sharing that. So would you share any best experience so far? Each one from Tyler and Jason.
Best experience so far in mobile home parks. Well, in this partnership, I'm the pessimist and Jason's the optimist. Thank God we have an optimist, So I'm kind of the glass half empty guy. But I would say probably one of my best experiences so far is we bought a property called Arch Estates. And Brahma, I don't know how well versed you are in mobile home parks. But it was 100% rental. So it was 100% what we call park-owned homes in the business. So again, ideally, you want all the homes to be resident owned, right? So then you don't have to take care of all the toilets, termites, and trash, right? And so this was 100% park-owned home. So we were responsible for the home as well as the dirt underneath. Basically, we implemented a strategy, and thank God we did it early on, and not with other people's money, but we implemented a strategy where basically we kind of aggressively try to force everybody into a rent-to-own situation, meaning, you're a renter now, but we're going to convert you to a rent-to-own so that in 60 months, you're a homeowner, right? And during that 60 months, if anything breaks, right, then the repairs and maintenance are on you. So that's how we kind of aggressively did that. Well, what ended up happening was we had a 50% vacancy in the property in the first 3 months. So it was to say the least. That strategy did not work, failed. So anyways, to make a long story short, we basically had a 50% vacancy. We ended up going in and rehabbing all the homes, getting them filled. The property's at 96% occupancy now. We paved the roads. We kicked out a lot of the bad actors. We did a ton of work to that property. And it's now probably our best performing, or one of our best performing assets on a cash flow basis. And it's in a pretty good part of Little Rock, which we didn't realize kind of the dynamics when we first bought it, but it's kind of out in the country, so it's a little quieter out there. But it's nice whenever I drive through that property, kind of seeing where it was and now seeing where it is. I mean, that was a pretty good, it was a cool lift for me. And I like seeing that kind of, you know, we had, you know, this type of asset when we bought it, and now we got, you know, kind of at Z, we have this kind of asset. So that was a pretty good experience for me, especially because at that time I was on site like every day, managing contractors and doing stuff like that. I've taken kind of a step back from that now because we've got a lot more assets. But yeah, that was probably one of my best experiences.
Sure, thank you, Jason.
Yeah, that was definitely a good one. And, you know, I think one of mine is, and it's kind of two in one, but we had our largest acquisition was the 122 units we've referenced a couple of times. And so, you know, for that one, I mean, just getting the first deal done, right? The 68 units, that was huge just alone, right? So that was one, just saying, hey, it's possible now, figured out the pieces, we do this thing, right? That's always a good, just the first one, because you know, your subconscious knows now, hey, you can do this thing, and then you're off and running. But, you know, taking down the first over 100 units on one clean parcel, I mean, that one, we walked in, it was in a trust, and there was 30% delinquency at that. There was bad debt, just part of the trust would just go grab cash. Nobody was even managing this thing, and it was just out of control. And we got a really good deal. It was $2 million. And it was really even our first kind of raise going into that syndication structure too. The 70-30, we had it a little bit different with the way we're paying back, but we were even raising funds for these delinquent payers. And we went in there with a little bit different approach than sometimes we've gone, like with the Arch example, but you know, we wiped their slate clean and put a no pay, no stay. And we ended up after that first month, 98% collected. And so that doesn't always happen. And just all of it together, you know, hey, this is our largest asset. We went and raised the capital from a small family office that Tyler and I flew in, met them in their, you know, mansions. And so it was it just, you know, for me, it was kind of the first larger asset, kind of the A to Z from the syndication model that we were, you know, getting into, from just getting away from the JV, the joint ventures that we've done. So that, you know, that was a big one, which actually spawned off that same group bringing us in on a deal that was completely mismanaged. People were stealing from them. They were spending $50,000 a month. And so they actually brought us in as equity partners to get in there and turn it around, and now completed that project. So that was the kind of the 2-to-1, just really good partners, just a good, you know, first kind of structure in that syndication format on a larger asset. So that was probably one of better
Awesome,
stories. Yeah.
thank you. So would you also share any challenging experience? We'll start with Tyler.
Jason brought up the 43 spacer, and I'll let him talk about that we kind of partnered with that family office on. That has been a challenging project, but the one that we own a property called Broadway Estates, and it's an 18 space property. We ended up buying it, and thank God, because it's the only thing that saved us. We ended up buying 18 spaces for $248,000, if you can believe that. And it was all, again, park-owned homes and older park-owned homes. And the problem with older park-owned homes, and again, Rama, if you know a bunch about mobile home parks, but older park-owned homes, the problem with that, when you try and sell those back to the residents, nobody wants those homes because they're in such poor shape. And so you have usually people run out the door. And so now you're faced with kind of a, you know, an A and B scenario. A, you fix up the existing park-owned home, or B, you tear that home down, right? And then you put in a new home. Well, then, you know, the both of them face challenges. If you try and fix up an old park-owned home with a bad floor plan, you're going to probably take a significantly haircut. You're going to take a large discount on how much you can rent that thing for. And if you tear it down, you're in 40, 50 grand on a new home. And you've got chattel debt now, and you've got all this overhead, and you don't know if you're going to make your income back. So what ended up happening is we evicted 80% of the property here. And we had tree work and paving and a bunch of really bad residents, and told the story a bazillion times now, so people are probably sick of hearing it. But I had a woman I served an eviction to who looked like Brian Urlacher. I don't know if you know who Brian Urlacher is, Rama, but he was a large fullback in the NFL. So like him. and she took a swing at me when I served her with this eviction notice, and she fell down her steps and landed in a mud puddle and then chased me back to my car. So that was the type of residence in this property, and it's continued to kind of limp along because it's such a small property in such a bad area with basically a bunch of homes that are in just horrible condition. And so we've tried to fix it. We've tried to put up fences. We've fixed sewer lines. And just the area is so bad, we can't get quality residents in there. And so that's been a challenging asset for sure.
Got it. Thank you. Jason, you want to add anything?
That 43 that we took over, I mean, it was first day, I mean, they had a crew of maybe 12 guys over there that were on an hourly, right? And so that tells you something. We came in there and said, okay, no more hourly. We're going to get the bids and we're going to review those. But everybody quit. Well, what does that tell you? You know, that $50,000 payroll that was going out every month, and just turning that situation around. Everybody quit, and then, you know, Tyler's on the ground. He's managing these contractors. So, I mean, that was a huge challenge in itself, busting everywhere and terrible tenants to get out. But converting those homes, I mean, that's tough too, that a lot of people just don't talk about. But yeah, crew, I mean, that was a tough one. And yeah, we just now, I think, filled the last home there, and it was about a year and a half project. So, but yeah, the Broadway, that was probably the biggest one. But
Thank you. So what's your plans for next 12 to 18 months or next 5 years?
Yeah, next 12 to 18 months, we're just going to continue to grow the company. And how we do that is we buy more parks. And as I said before, we're under contract on 281 units right now and raising capital for those deals. Again, we view those 195 and then the other one's 86 spaces. So we view those as kind of our bridge into these kind of larger assets. It's institutional scale, which means we get Fannie, Freddie financing, et cetera. So we're going to start targeting more assets like that, continuing to grow the company. I mean, we'd like to buy and somewhere between 500 and 750 units here in the next 12 months. And that'll put us closer to the 2,000 unit marker. Goals, good, bad, or indifferent. If we go into a recession or not, we'd still like to continue to buy. And obviously, we're not going to buy with reckless abandon, right? We're going to make sure that our investors are taken care of. We're going to make sure that our buy boxes are being hit. We did great deals out there for our investors, and we got a lot of margin of safety. I mean, just for example, the 196 space deal that we're under contract on that for $27,000 a pad. Northmark just came out with a manufactured housing report, and their average sales price across the nation right now is $50,000. Their average sales price across the Southeast right now is $41,000. We just saw a park trade in Little Rock in a flood zone that was 220 spaces for $13.1 million, and we're under contract on this property at 5.1. So I think we got a lot of built-in equity there. And again, I'm explaining that because, again, we're buying these things right. We're not buying them, again, we're overpaying and betting on the appreciation. We're buying them with existing cash flow, something that can float the debt service, and asset really that's again, pay generationally, we believe. So growing the company on a go-forward basis, and that's our plans, over the next, 12 to 18 months.
Got it. Thank you. So Jason, you want to add anything?
Yeah, no, I mean, we've adjusted our buying criteria a little bit, right? With obviously the interest rates, but we're still finding deals, and we're bringing on some really good talent here now. End of this month, we're bringing on managers and some upper management that's going to help us scale, but we're going to find deals in any market. So our outbound efforts have now good inbound flow, but we're going to continue to keep buying right, and that's it, buying right, because making random offers out there, and then the projects too, we're looking at those a little bit harder now. It sounds easy from a broker. Oh, hey, just infill 50 pads, but challenging than sometimes said. We're buying them right. That's it. That's all it comes down to. So.
Sure. Move towards personal side. So any habits that are helping you to be successful? So we'll start with Tyler.
I think resilience. I speak for myself. I've never been the smartest, never been the fastest, never been the most athletic, never really been anything special. But what I can take is I can take a punch right in the face and then get up. I think that resilience allows you to be really successful in any endeavor that you do. If you want to go join the NBA, I don't know, there's some God-given talent there that you have. But when you're doing entrepreneurship, it's about resilience. It's about getting up, because it takes years, sometimes decades, to really kind of build something that's going to be paying you how you want it to pay you, or build it to where you want it to be. and it may be decades of, or years, I should say, of no return on your efforts, no light at the end of the tunnel. Or you may think the light at the end of the tunnel is a train and not light, you know? So I think resilience is really something that's helped me persevere through and help us, you know, I don't know if I would call us successful yet, but help us, you know, kind of continue to grow that and become successful hopefully one day. So.
Got it. Thank you. So Jason, how about you?
Yeah, no, the resilience, that's a great one. Cause I was said persistence, that's in it a whole life too, right? Going back kind of like, you know, even athletic, right? I was never the biggest, strongest either. And it was just competitive, you know, competing in this world is getting the deal done, right? Proving a model, right? Oh, you can't do that, or, oh, that. And so, you know, that's been a big one, but just, yeah, persistence, really. I mean, even, you know, just setting goals where, yeah, I'd love to 25 calls in the morning, 25 in the afternoon. Once upon a time, that was consistent, you know, but as long as every day something like, oh, I might have made 5 calls yesterday, you know, but just moving forward, just persisting and, you know, knowing like, just keep your head down, you know, one day you'll look up here and you'll be somewhere where you plan on going. But yeah, persistence, that's a big one, because it's tough when you're not getting that instant gratification or that 2-week paycheck, you know, that's tough for some people. So just having that faith, right? Self and others,
Awesome.
you know?
Yeah, thank you. So books that impacted your life. We'll start with Jason.
Yeah, you know, a book I read a while back on goal setting, actually, it was called The One Thing, Gary Keller. And, you know, that was a really good one on, and I do something called a 12-week year. That's another book, and it's a short one, but I try to do that every quarter, trying to do more in 12 weeks than most people do in a year is the best. But yeah, I mean, the one thing that was just really good, because I always had goals, like big dreams, visions, but that's all they stay, write it down and actually know how to set your goals. So that was a really good book to just show, hey, you don't just think it and dream it, you know, write it down and have a plan, more of a plan of action on those goals, right? And so now I do, yeah, daily goals, weekly, monthly, into this, you know, 6-month, year, 5-year. And so that was a really good one, just to get goals and putting them into action.
Sure. How about you, Tyler?
Extreme Ownership. I really like that by Jocko Willink. I liked, you know, kind of hearing about his, you know, war stories, as well as, you know, how he implemented that in business. And he's a beast too. I mean, how could you not like that guy? But I got a lot, because where, you know, I struggle a lot with in this business is with the employees. Painful job for me, in all honesty. And so what I found is that book has allowed me to, in some instances, I am human, but in some instances, it allows me to kind of take a step back and realize this employee is screwing up, but they're screwing up because of me, right? I haven't properly led them down a path to where they can be successful. What can I do to continue to, versus me getting upset that, you know, something didn't get done, right? Then take ownership for it, just like he says in the book, for all of the actions kind of within your sphere of influence. And so I really tried to implement that in our business here. Far from perfect, as Jason can tell you. But I think everybody should read that, whether you're in entrepreneurship or you're married or you got a girlfriend or kids or whatever. Taking ownership for people's mistakes that are in your sphere of influence, I think, is a really powerful thing, because you can always help somebody kind of be better if you want to take responsibility for it. So I think that's definitely that book is definitely something that I'd recommend people that read that are in any facet of their life. So
Awesome. Thank you very much. So how can listeners connect with you, Tyler and Jason?
yeah, go visit us at www.mhcigroup.com, and that's mhcigroup.com. You can visit our LinkedIn. Jason's more consistent on LinkedIn than I am, but I throw out some flyers every once in a while. I got some operational stories and stuff like that, but Jason definitely has the meat of the syndications and how to raise money and blah, 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 blah. He's really good on there. And you'll email us if you want to set up a call to kind of review any of our deals or just pick our brain about park-owned homes, resident-owned homes, private utilities, anything to do with mobile home parks. Contact, you know, me at Tyler at MHCI Group, or, you know, Jason at MHCI Group. And so those are really the couple main ways to contact us. Jason, did I miss anything?
That's it. Manufactured Housing Community Investment Group. Quite the mouthful. That's why we trimmed it up. MHCIGroup.com. Yeah, that's where we're at. We're always on too. Our deals are on there, and yeah, we're always open book. So
Awesome. And thank you very much, Tyler and Jason. Thank you.
Rama, thanks
Thank
for
you,
having us.
Ron.
Appreciate it.